All right, everyone, welcome. I'm Serafina, and for those of you joining on Zoom live with us and on LinkedIn Live, hello again. So this is the road to Onward FX, and if you're joining us for the first time, this is a series that is the lead-in to Onward FX, which is our IRL event. Um, that we host here in Bentonville in April, where we're bringing in 50 pre-seed through Series B investors to meet with um, hundreds of startups. And historically, 25% of those companies, they've walked away with term sheets in the 2 weeks following the event. So if you are raising, you really ought to be in the room where it happens. The deadline is tonight, y'all. The deadline is midnight this Monday, today, Monday, and you can scan the QR code. We will follow up via email right after this event. You can fill out your profile and hopefully you get selected for one-on-one meetings. 50 investors all in one room together, April 21st. So, the Road to Onward FX is our series where we help you show up ready for those one-on-one conversations. And so far in the series, we've covered what the 2026 fundraising landscape looks like with our friends from Carta. Peter Walker walked us through the data that was hot off the press. We discussed what fundable actually means in the eyes of the investor. And that was with Mike Cardamone of Forum Ventures. And last week, we had a session with Nick Moran. A little spicy, but what are investors thinking that first 10 minutes when they're sitting down with you? What are the ideas that are forming in their head? What are the patterns that they're looking for? And today we are closing this series with our friend Haley of Hustle Fund. Thank you, Haley, for being here. And today's topic is how do you know your venture scale? So this is actually perhaps the most important question of all. And sometimes it's one that founders can skip right past. Um, you shouldn't look at fundraising as a default next step. You should stop and maybe ask yourself, is this the right tool for the route that I am on? And Haley is going to walk us through sort of her framework for thinking through that. But before we get into it, I want to introduce our guest speaker today. Haley, thank you so much for being with us. You were
Thank you
with
for
us.
having me.
Yeah, absolutely. You were with us when we first kicked off this program, and it was six funds. And, it was an immediate yes. And I'm so grateful for that. The program has grown tremendously since then, and we're welcoming you back this April.
I'm so excited to come back. And Serafina, you are such a force. One, congrats on all the progress you've made with and for your ecosystem. And I'm just excited to see you in person, to get to meet so many
Yeah.
awesome founders, and to nerd out with the dozens of VCs you're gathering. I remember that first day in conference rooms, just I think in or right next to Walmart's HQ. And I got so excited about a startup I committed within a week of that meeting. So I know there will be more of those opportunities in just a couple of months, and excited to meet many of you in real life, hopefully in Bentonville.
Yeah. We're so excited to welcome you back. Okay, so here's where I will take a step back and hand it over to you, Haley. So why don't you take us away and also introduce yourself?
I will intro myself, and I asked for permission to share my screen. I do have some slides for y'all. Great. I think we'll share this screen and hopefully this works for everyone. Um, one second. Okay, cool. You can see my screen, right?
Yes, we can. And
Perfect.
while you get set up, I just want to remind everyone, you guys can ask questions in the chat and we will get to them throughout the presentation. And at the end, if we don't get to it, feel free to use the Q&A feature or the chat directly, and we will be monitoring it.
Awesome. Thanks, Serafina. And I have asked Serafina to interrupt me as we go so we can have a conversation. You've joined a few of these presentations already, and heard from some of the best and brightest in the industry. So I don't want to bore you and just talk at you. I really want to understand what's top of mind from some of these conversations and as you're applying for venture capital funding. Before I jump in, I'm Haley Bryant. I'm a partner at Hustle Fund, where we back hilariously early companies. 7 years ago, I didn't know what venture capital was. I started my career at Apple and joined a couple of startups that both went on to be acquired, running customer success and product teams. And then I scaled a B2B SaaS, if you can still say SaaS, we can talk about that, content marketing agency where I got to work with the A to Z of venture-backed startups, from Amplitude, Auth0, Airtable all the way through to Zendesk and Zapier. And it was there on my second day that I really understood what a startup means. And I read that seminal Paul Graham essay, Startup Equals Growth. So we'll talk about a little bit of that today. And I'll share a bit more about Hustle Fund, where we're backing hilariously early companies, first check 50% of the time. I will go ahead and jump in though. And if you're curious about the hippo corn, this is Donkey, our mascot. One of our GPs, Elizabeth, has a thing for hippos, but more on that later, perhaps, depending on your questions. So for today's conversation, we'll talk through a few things. First, as Serafina said, what types of funding to consider before jumping into VC. If you are pursuing VC, what you need to show VCs for them to believe in backing you and your business, what the process looks like. And I'm going to get very tactical here. Hopefully, you won't fall asleep, but really talking you through how we look at our pipeline and kind of go from that giant top of funnel to the actual checks getting wired to founders literally every week. And then how to know that you're ready and run a process that will win and convert. I want to save as much time as possible for Q&A. Again, I'm here live because you could all look this stuff up on ChatGPT, et cetera, but it's more fun to get into the nuanced questions. And, as with all things, it depends. I hope you'll share what's really going on for you. We know that it's through your vulnerability that we all get to learn and level up together. I was extra excited to have this conversation now when Serafina reached out because I do think that what venture scale means is changing rapidly. You've probably heard rumors of the SaaS apocalypse. I'm not sure what the timing was of that Peter Walker session, but it does feel like the ground is shifting under our feet really rapidly. And that's exciting in a lot of ways. And hopefully we're running towards that ambiguity, but it does influence what it means to pitch a great idea today. So let's go ahead and jump in. For starters, I think venture capital over the last decade or so has become super in vogue. Everyone dreams of being a unicorn or maybe a hippocorn. But for many businesses, venture capital is not the best tool to reach the sort of scale that you're hopeful for. If you've read that seminal Paul Graham essay I mentioned, Startup Equals Growth, you know what differentiates a venture scale startup from a barbershop down the street. It is the ability to grow massively, and not linearly, but in a way where your costs don't increase with every customer that comes on, right? That's what investors have loved traditionally with the venture model. It also means that, well, a few things that we'll get into, but stepping back for a second, there are lots of other tools you can use in your fundraising journey, and we often see founders combine these tools. It's not black or white, it's gray in pursuing funding. So as you're thinking about what's available to you, many of you are probably aware of grants. There are so many ecosystems like a Bentonville that have created incentives to make it easier for people to start and build businesses and stay in those ecosystems. What's really nice about grants, as you know, is they're non-dilutive. You're not giving anyone else ownership in your company. So, especially while you're really early trying to figure yourself out, this can be kind of the first rung of the ladder to get started and experiment. We, of course, see grants used even more in biotech, in deep tech, in dual use, where there's funding coming from government entities that have very specifically aligned interests with those companies. Bootstrapping, hopefully there are some bootstrap founders on the call or seed strap founders on the call if you've heard this term floating around over the last year or so. As the fundraising landscape shifted and we saw more and more capital concentrated into fewer deals, a lot of founders were like, look, we don't really need VCs. We can build really cheap and really quickly with the tools that are available and maybe just raise a little bit of capital, like a $500,000 round, $2 million round, and then get to profitability to kind of choose your destiny. One of our GPs, she and co worked for NerdWallet after years at Bridgewater and IVP, a much later stage fund. And NerdWallet at the time, and you almost wouldn't believe this now that they've IPO'd, but no one wanted to invest in them because VCs did not like or understand the business model. If you're sitting at home nodding your head like it's me, you understand. So they said, okay, we don't need venture capital, and they bootstrapped the company to $50 million in revenue before they went and raised institutional capital. So there are multiple paths available. We often see bootstrapping or seed strapping combined with revenue-based financing, where if your customers are paying you, you can pursue loans, but not traditional loans that you have to kind of underwrite with your house or personal assets, but with customer invoices or your funding. I think Pipe was really popular for a while in startups, the company that made it easy to borrow capital based on your monthly recurring revenue. And there are so many more options out there and actually funds dedicated to revenue-based financing now. And then, of course, strategic investors. And this is actually, I would almost say, like within the venture capital universe, but there are lots of different flavors of VCs. And you may have noticed this as you've networked at parties or reached out to people cold. Not every investor is looking for the same thing. So if we think about corporate venture capital investors, this might be someone working at a bank, an insurance company, increasingly these large labs and LLM providers are creating their own VC funds. Their interests are not only in the return that they might get on capital, but their strategic interests. And those interests could be very short term. So, what is something that I could invest in and bring into my business today that could create impact today? And then longer term, what is something that I could invest in that will help me be resilient for the next 5 years, the next 10 years, the next 30 years? So that can be a really great option because you're pitching on something different than just this is going to make you a butt ton of money. Um, Impact investors, of course, often investing with a double bottom line. It's not charity, right? This is not philanthropic venture, although that does exist as well. This is investing still with returns in mind, but with something they want to underwrite. So we see this a lot with maybe the UN, United Nations priorities, for example, around health, economic mobility, that kind of thing, which can be great alignment. And these are still venture capitalists, but the type of venture capital I'll primarily talk about today is like just the pure capital for capital gain kind of investing. And then I put angels under strategic investors because they can be super strategic. They can often move really quickly since they're not pitching to an investment committee. They don't have to convince anyone else to write a check. They can decide on their own, and they could be investing for a number of things. At Hustle Fund, which I'll talk about more in a second, we have a community of angel investors called Angel Squad, over 2,500 people all over the world. And people join to invest, of course, but actually 40% of members join just to learn. Some people say, you know what, I didn't get an MBA. I'm going to invest the amount that I would have spent on an MBA. I actually had this conversation with someone in our community just a week and a half ago to be able to learn more about startups and support missions that I believe in. And this was with an angel that we co-invested in a company focused on rebuilding the foster care system. So, I said we're not impact investors, but you can find alignment across lines here. So all of these could be great options. You've probably thought about them at least. And I say it because if you're going after pure venture capital, you just want to know what you're signing up for. What's great about some of the other options is you maintain potentially more leverage, more ownership, more control. When you sign up for venture capital, and I am a VC. I have lots of VC friends. I generally really like VC, but I actually talk to founders often about, okay, if I was building a company, like who would I take money from? And it's we say maybe it's not always an option, it's not always that easy, but knowing what the trade-off is. So first, like I said, startup equals growth. When a VC invests in your company, often they're investing with kind of the LP, their limited partner, breathing down their neck. So limited partners invest in venture capital funds to get 3x, 4x, 5x plus return over the life of that fund. And every fund's different, but for ours, for example, it's a 10-year long fund. So they have to believe that the opportunity cost of putting their money into our fund is worth it versus, say, the S&P 500. So to be able to return that level of capital, every investor has a different sort of setup, but they are essentially putting companies on a treadmill where every 18 months, 24 months, 36 months, the expectation is that your company is going to increase in value. And to do that, that means you have to grow really quickly. You have to make trade-offs in how you run your business. And that means a lot of external stakeholders often. And Serafina's probably like, wait, stop, don't, this is it's like we're pitching people to come and talk to VCs. We don't want them to be scared. I don't want you to be scared. There are a lot of amazing and very founder-friendly VCs that I admire and deeply respect that will be in Bentonville in April. But again, just know what you're signing up for. This can also mean accelerating your burn, so how much you're spending, which can create all kinds of pressure as you go on to raise each round. What does your revenue need to look like? What does your team need to look like? And kind of changes you have to make along the way. I think we might have a question. Okay. What is your perspective on crowdfunding platforms? Patrick, thank you so much, Patrick from Kari Health, for this question. If a company uses that mechanism as part of their fundraising strategy, does that change anything in the way you evaluate investments? So I love this question. I'm going to update this deck after the presentation based on your question because crowdfunding, I think, is so misunderstood. And like any tool, it can be great if used well and used intentionally, just like venture capital. So as long as you know what you're signing up for. So most of you know what crowdfunding is. If not, crowdfunding is a way to bring small check investors in to invest in your company. Very similar to having an angel group invest in your company through a tool like AngelList, where they all invest through what's called an SPV, special purpose vehicle, and that shows up as a single line on your cap table. So instead of having to manage 100 or 1,000 individual small check investors, it's nice and clean and tidy and easy. Crowdfunding does that, but instead of $1,000 minimum, like angel investing requires for angels to be accredited, which the SEC has a long write-up about online, but things like $200,000 income, certain financial certifications, crowdfunding is more accessible. So pros and cons to crowdfunding. You can bring a lot of people in, which can be great, especially if you're a good marketer. I think crowdfunding can make a lot of sense if you are a consumer business and you actually want your customers to be able to invest, and not all of your customers can afford to invest, right? Like these larger checks. So it can be a way to build affinity and brand and community really early. I have a portfolio company doing this right now, autonomous drive-through for coffee, starting with coffee. The downsides of crowdfunding are that often the question that a VC will ask once the conversation gets to that point is, why did they crowdfund? Like, was this the only option? So when you think about the different sort of options that I already shared, if we go back a slide just for a second, grants, bootstrapping, revenue-based financing, strategic investors, I would say that crowdfunding is probably looked looked upon the least well of these options. But it really depends on who you're talking to and what type of business you're running. So again, if it makes strategic sense for you to crowdfund because it's a way to engage your community, then you like do it, go for it. But if it's because it's the only option, it could be looked upon later in terms of, oh, this is a little bit messy. But longer conversation if you want. Feel free to reach out directly. We'll continue. Thank you again, Patrick. And just to make the power law clear, uh, venture capital is kind of underwriting this belief that over a 10-year period, the lifetime of the fund, your business can become worth 100x whatever a investor initially invested at least for us as pre-seed VCs investing in a lot of companies, that's what we need to believe. So often, and it's going to depend on your industry and your growth rate and all those sorts of things, what we're looking for a clear line of sight towards is $100 million in revenue at minimum within 10 years of us investing in your company. So that trade-off is in part, do you want to own 100% of a $10 million a year company or 10% of a $100 million a year company? And it's not that simple, right? I think what we've seen in the market over the last month, if you're following the markets closely, is the expectations are changing as there's this question of what's going to be defensible long term from the Claude bots or open claws of the world, the Claude coworks of the world, the OpenAIs of the world. Is software enough? And in many cases it is, but that means that the bar to raise is continuing to go up. I think there's another question here. Nate, thanks for this question from LinkedIn. For founders who are bootstrapping pre-revenue and can't afford to go full-time without capital, but keep hearing that VCs want full-time commitment before investing, how do you navigate the chicken and egg problem? Is there a specific milestone or signal that makes a part-time founder investable in your eyes? Oh, okay. Another great question, Nate. Thank you for sharing this one and whoever asked on LinkedIn. So, transparently, and I probably should introduce our fund, right? So I don't get fired. That's probably a good idea. So, at Hustle Fund, we are a pre-seed fund. We invest at the earliest stages in B2B, fintech, health tech. Of course, AI ML is mixed into all of those things. Um, there are certain things that we do look for as sort of the minimum requirements for us to invest in a company. So stepping back from your question, I promise I will answer it in full. Uh, the way that we work at Hustle Fund, we see over 1,000 companies a month. We meet with 50 to 100 of those teams, and then we end up investing in about seven of those companies a month. And that's between our four-person investment team, the three GPs and co-founders, Elizabeth Yin, Eric Bond, Sheehan Co, and myself. So what does it actually take to move down the funnel? And there's some kind of basic screening we do at the top level. So 50% of the companies that apply to us cold, we do talk to, and we will invest cold in companies. I actually had a company announce their Series A today, Go Coral Care. They applied cold just over 2 years ago, 2.5 years ago. And we've just been thrilled with their growth. So we love cold inbound. We do not require warm intros. But to help us with the filtering process, there are certain things that will knock companies out of the running for a conversation with our team. This is stuff like, are you selling physical goods? Like we don't invest in CPG companies, so we're not going to invest in those teams, or we're not going to spend time on those teams. If you're already at Series A, we're pre-seed investors. We're not going to schedule a meeting. We don't want to waste your time. One of these questions is around, is at least one founder on your team full-time? And I realize that it is a privilege to get to build your business full-time, which if you're at home working like 19 hours a day on your business, like grinding like crazy, it's crazy to step back and think, wait, this is a privilege. I'm like maybe making less than when I first graduated from college or whatever. But if you have a family, a mortgage, um, school debt, any of those sorts of things, it can make it really tough to go full time. So, the things we would sort of look for to be willing to write a check, we have to know that there's a very clear line of sight to you going full time on the business. Um, and it can't just be getting $150,000 from us because we're a pretty small check, right? Uh, and that's not going to take you super far. It ideally is something that's, really clear in the business, like an inflection point. So, you have three customer LOIs now. Once you have one paid pilot, you'll go full time. Something like that is really helpful for us. So in terms of like that initial screening, 500 companies get kind of knocked out immediately. So then which ones that we take a closer look with do we actually dig further into? Do we actually want to spend time? Oh, and thank you, Chris, for the question. Which companies do we want to spend more time meeting over a call? And there are a few things that jump out. And Salim, I'll come right to your question after this. So the first is like, are you a little weird? Which may be overly simplified, but because we see so many companies every month, there are certain companies that we almost open our inbox expecting to see, right? So we see at least one dating app a week, at least one company trying to solve the loneliness epidemic every week, at least five sales enablement tools and five recruiting tools. And so there's like this bucket of sort of known problems where, yes, you could make a difference. You could disrupt the industry potentially, but the level of competition is so fierce, and the amount of capital it will likely require to disrupt that industry makes it less exciting to us based on our portfolio construction. And going back for a second, again, every fund's different. And sorry, this is a terribly generated ChatGPT image. None of those candies look very appealing. But anyway, so as a fairly diversified fund, investing in a lot of companies, writing small checks, believing that founders can go really far and be scrappy without raising a ton of capital, we tend to avoid competitive spaces. The funds that are investing, 1 million, 2 million, $3 million round, $3 million into a pre-seed round can probably make bets in spaces that are pretty crowded on the face, but they can actually help kind of subsidize the cost of customer acquisition, which is kind of what happened during that ZERP period. If you remember all the really high valuations and mega rounds and all these things happening. So it's just not kind of how we play. We prefer to focus on unique ideas and companies. So, for example, I've been talking to a company in the optical comm space that's trying to make it easier for satellites to communicate with ground stations via lasers. Like, and I took that meeting because of nothing other than the idea being really compelling. And then during that meeting, I learned more about the founders and I learned more about their execution and how they're progressing. And that was really appealing. So uniqueness is huge. Founder market fit is another thing that's really important to us. You've heard this thrown around many times before, but do you have some unique right to win in the market that you're playing in? And we think about this in terms of product building, sure, but especially in terms of distribution. If we think about the shifts that are happening right now, we are kind of the time we're in is a lot of things are changing, but it's so easy to build product, much easier, at least. Like I'm building stuff, which is really scary, right? So is my dad. He launched something on Product Hunt. We'll talk about that more later. So can you distribute to customers in a way that others can't? Can you get to a lot of customers quickly? Um, and this is changing too, because if and as we move in a faster way towards this like agentic economy where it's agents buying from agents, like distribution is going to look very different, right? So that's one of the things that jumps out at us. So these are a few examples, and we can drill in on anything you're curious about, but of how we'll move into one of those 50 to 100 meetings and then eventually into a check. Okay, let me answer a couple of questions from the chat. So first from Salim, as a pre-seed investor, are you investing on a safe or is it a price round? So this is a great question. Because we are very early and fairly small check investors, we typically invest on a safe, which is an agreement for future equity. We use the Y Combinator template version 1.2 available on their website if you want to take a look at it. We like this, as Peter Walker may have shared, looking at the data, the post money safe, because post money lets us know how much theoretical future ownership we may have of the company at conversion. It's really simple, which keeps legal costs really low. Whereas when we're investing in a price round, our lawyers have to review the documentation. We're spending, at least $1,000 on that, and that kind of scales quickly. There also isn't a lot to underwrite typically at pre-seed. Now, you see these rounds in the news that are like $100 million rounds. I really hope those are price rounds. We're not generally investing in those. But yeah, we prefer generally safes with some exceptions if it's a larger round, and it requires that kind of structure. Steve is asking about seed strapping. I love that we're going back to that. Like, let's just spend more time on seed strapping versus venture capital. So, for seed investors, do they want to invest in seed strap companies? In the good old days, 4 years ago, seed investors sought to get in on companies that had signed up for the growth story. Has that changed? So, I really like this question. It's quite nuanced. So, as with all things in life and in venture, Steve, it depends. Um, every almost every investor has an LP to answer to. And this kind of comes back to the strategic investors I mentioned at first. Like a corporate venture capitalist that's investing more so for their product roadmap than for their balance sheet has very different return expectations than our phenomenal and highly reviewed limited partners who are investing with very specific outcomes. Um, Seed strapping does not mean that you're not growing either at all or even as quickly as other startups. It's more about capital efficiency. So, to kind of play out two paths, what often happens in venture capital, especially in these more competitive spaces, right, is to be able to compete, to acquire customers because customer acquisition cost is so high for, say, HR tech. Founders have to raise a lot of money and they have to raise a lot more money and a lot more money, which means your revenue needs to be high enough at each milestone to raise at a higher valuation and to not dilute founders down so much that, you're completely unincentivized to kind of continue on the relay race. If you contrast that with a seed strap company that's maybe in a less competitive space, you may not have to grow your revenue like quite as much, that the numbers don't have to be as high because of dilution. If you're raising less capital, then the investors and the founders will get less diluted with each round, which makes and I like should pull up a like whiteboard to do this, but it will make the venture math sort of different. So seed strapping is not a growth trade-off. Investors are still underwriting high growth. It's just the belief that you can do it in a much more capital efficient way. And there are a couple of great articles from David Sachs of Craft Ventures. It's a bit politicized now, but we won't go into that on the burn multiple that I recommend looking up. I think what people backing seed strap companies want to believe is that your burn multiple can be really low as you grow. Cool. Ashish, did you mention 100 million revenue in 10 years or 100 million valuation 10 years? This is a great distinction. So let's go back for a second. Um, okay, so actually, maybe the best thing to do, let me see if Bessemer Cloud Venture Index. I hope I'm sharing the right screen. Can you see my Google search,
Yep,
Serafina?
we see
Okay,
you. Hmm.
perfect. Just checking. So let me see if this pulls up here. Okay, so I'm on the Bessemer Venture Partner Cloud Index, and this is basically showing you what the valuation is of publicly traded, mind you, SaaS companies, so software businesses, in today's market. So they're trading at around 6x of their revenue. So let's pretend, Ashish, that I'm a pre-seed investor. Okay, that's not pretending, that's real. That invests in your company at 6 million post today. I believe that by 2036, you can exit that company for $600 million. dollars. So that 100x from the entry point valuation. And if we think about what the revenue multiple is, your revenue is probably at least $100 million dollars to get to that exit, whether it's through an acquisition, through a public listing, or by me selling my shares in your company to a Series C, D, or E investor who's willing to buy secondary shares. So hopefully that makes sense. It's the belief in a 100x return, so at least $100 million in revenue. And typically that valuation has to be much higher, but maybe you're raising 1 million post and we can make the math work that way. Let me answer a couple more questions here. So Nate shared another question from LinkedIn. Florian from Germany asked about family offices. So let's go back. I would bucket family offices under strategic investors, often akin to angel investors. So for anyone who's not familiar, a family office is uh, often founded by someone who has become wealthy through, building a company, being an early investor in an Alibaba or one of these, gigantic companies. And I think we'll see a lot of wealth creation this year. Reports say there will be at least 16,000 millionaires created this year, if OpenAI, Anthropic, and SpaceX were all to go public. This is based on research from Sacra. But you could imagine all of those new millionaires saying, "What do I do with all my money? I will create a family office and I will invest from that." So they can create generational wealth. Again, they often have a lot of flexibility. I I think family offices can make sense. I guess the one caveat there is a lot of family offices do want to invest directly, but maybe unlike an angel investor who's currently working at an OpenAI or Anthropic or whatever, they may not have the access to deal flow to assess and or the resources to assess. Um, so definitely an option if you have access. I think actually family offices are probably the hardest capital source to find because most people do not want to advertise their wealth in that way. We'll take one more from LinkedIn. I'll continue. Tejas, thanks for your question. Are stablecoin-based fintech startup seed stage, especially those focused on developing markets, a priority for investors currently participating in FX? And Serafina, this one may be for you just based on like who's going to be kind of at the show. I will say that our one of our top performing portfolio companies, Reap, is stablecoin infrastructure, and they are absolutely crushing it, doing like $150 million in revenue, profitable. Last raise at a valuation lower than their current revenue. So we're looking at a lot of stablecoin infrastructure, and I think there's been a groundswell of support. Several YC companies in the latest batch are stablecoin. I would imagine there's interest from fintech investors who will be attending, but I defer to Serafina.
Yeah, absolutely. Tejas, if you want to send me an email, happy to chat more about the funds that are participating this cycle.
Okay, awesome. Thank you. We'll answer one more and then just talk a little bit about shifting from being filtered out to being interesting enough for a conversation to actually like crushing that conversation and then running a process. And then any other questions we'll jump into. As a non-technical founder with a long-term platform vision, what path to early funding do you see as most viable before a formal technical co-founder or CTO is in place? So this is a really interesting question. I've backed a lot of non-technical founders at Hustle Fund. I've been really lucky to. And I'm really leaning into this idea of the product manager as one of the strongest potential founder personas, like combined with an SME, for this kind of next generation of venture building. That said, a platform business, and I don't would love more details on what sort of platform business you're envisioning can be quite technically complex. Um, Not to say that you can't build it and absolutely crush it, but I think one of the things I've heard feedback from when I'm sharing the companies by non-technical founders with other VCs is to underwrite it, to get comfortable. They really do want that technical co-founder. So we don't require it, but many VCs do look for it. A few options. Ideally, it's not a marriage of convenience, but you can find someone who's willing to go on the journey with you if you're willing to bring in a co-founder. And there are various co-founder matching sites. Um, I would, of course, be very wary. I have seen non-technical founders in particular get burned by really bad advisory deals where an advisor says, "Hey, I'll be your like sort of co-founder. Give me 25% of the business. It's not going to vest, or it's not, there's no cliff for my equity to vest," and kind of like get screwed over. So definitely want to avoid that. But I do think a technical co-founder can be helpful for these super ambitious and more complex businesses. The company I mentioned today that just raised their Series A, Coral Care, they actually went through a venture studio called Purpose Built Ventures to help get their start and to get the support as a solo technical, but not like super technical founder. Um, Trade-offs there, and again, in terms of equity, but I think that can help. Aside from talent, another way to think about it is if you have the vision, you know there's demand from the market, if you're able to get to a place where you have, LOIs with customers and people who are willing to be design partners, that could be enough to take to someone who is a founding engineer, for example, with the right experience to come in and help you build. I think what VCs want to see is resilience and some level of redundancy, ideally. So ideally, you're not hiring in a primary part of the business if it is a really technical business because of the risk of that person leaving. So you're trying to like project stability, if that makes sense. Okay, let's continue in terms of what we look for in a deck, both in a pitch application and in a first call, and what really stands out to us. So we talked a little bit about team. Um, you have to solve or answer that question, like why are you uniquely positioned to build this? Why you? Why now? Things that have resonated really deeply recently are, I've thought about this problem for the last 10 years, 15 years. Like I've architected my career around solving this problem or learning enough to solve this problem. Um, Teaching investors something that they might not know. And I think this works really well, especially in competitive spaces. You have to surprise an investor really quickly. The fact that a space is either crowded or there are a lot of companies that have tried but failed is kind of the elephant in the room. So almost within the first couple of slides, you have to tell them everyone thinks this, but actually this is the thing that's true, to kind of surprise them. And our team's the team to build it because of these reasons. We're the foremost experts. We have exclusive distribution through these customer networks. Then we like to understand the problem, and what is the result? Like what happens because of the problem? So how painful is it? Can you measure it in work hours, in dollars lost? Because ultimately that's often why someone is buying, especially now. If you've looked at the reporting around why companies are buying and implementing AI, the first thing is often like cost reduction and productivity improvement versus driving revenue. We do believe that focusing on driving revenue will be a big thing over the next year plus, but the early reports from the enterprise level, from everyone from Morgan Stanley to Stanford, suggests that it's really productivity first. Um, and then solution, and ideally in your deck, problem and solution are almost parallel. So, people waste 100 hours per week, which equals $100,000 per year solving this problem. Our solution, this takes people half an hour and saves $99,000 a year to show like how much value you're creating. The thing I would add on top of that, and that we're all probably thinking about, is that whatever you're building can't be quickly disrupted. It's not a wrapper, it's not on top of an existing LLM. It's defensible in some way because of the data that you are collecting that's proprietary, you're generating for and with customers that no one else is getting, the network effects in your business. If you haven't read the book Seven Powers, I do think I agree with an assessment from Packy McCormick last week on this shift into strategy. I do think knowing what your mode is earlier is going to be really important to convince VCs to give you money. Market. So Ashish asked, like, how much revenue does a company need to make in that 10-year time frame? If it's at least $100 million and it's that 600 million plus exit based on valuation, of course, is the market big enough to afford that? And often as a VC, I of course love to see big markets. Um, Although, again, some of the biggest markets are the most competitive. So, what do we need to believe about the percentage of market penetration that you need to get to win in that market? Is it 10 or 20%, which sounds really high in a competitive market? Is it 0.1%, more believable? Is it growing quickly? I've actually spent a lot more time in my VC career in these underserved long tail markets with the belief that by investing in market expanders, if you think about the Ubers of the world that saw an opportunity to make traveling via shared car service accessible for everyone, that market exploded, right? So there is a pitch to be made around that. And that's actually a big kind of theme I'm thinking about as an investor now is everything's changing around us. And then lastly, traction. So at Hustle Fund, we say traction doesn't matter. That said, we do care about early execution. Have you had dozens of conversations with customers? Have you built an MVP in Rourke or Lovable or with Claude Cowork that you can demo, not just to us, but to customers? Do you have customers using the product, even if they're not paying for it? Um, because it's so much easier to make things now, the bar for traction is starting to increase, even if that doesn't necessarily mean revenue right away. Okay, another question from LinkedIn, and then we'll talk about customer obsession. As a non-technical founder, oh, I think we saw that one. Okay, sorry, we'll continue. So we look for customer obsession. So I say this because, in part, I guess, I have a customer success background. I spent a lot of time leading teams that serve customers, working in product, serving customers. And I still believe this is the way to win, like to know your customers better than anyone else. Not only what they need, what their problems are, what business outcomes you're affecting, but how they make decisions, how they adopt products, what their incentives are to adopt products, because so often, whether or not a pilot succeeds or fails depends on the incentives of the people on their team, right? So if the buyer is not the one using the product day to day, like what incentive is going to make that person use it day to day? And it's designing systems around that. It's kind of beyond problem discovery, which I think we're all getting better at as our ecosystem levels up together and into adoption. And I think that's kind of the continued, the bottleneck keeps moving. It's not building product anymore. We talk about distribution. I really think adoption's that next thing as we see companies exploding in growth, but struggling with retention for some of the dynamics I mentioned. Another question from LinkedIn. Thanks, Venkat. With the AI impact, these days we need less and less employees. I had a tough time convincing investors we don't need a fancy team anymore. What's your take on this now? I love this question. So, again, I think it really depends on what you're building. Um, I don't have a cut and dry answer. I definitely believe that more small teams will win in this era. We just saw the OpenClaw or ClaudeBot now, OpenClaw acquisition, one person team. Um, it's definitely possible. I'd be curious to know kind of what feedback specifically you're hearing for more complex products. You may need people around you, and I do think that you can start solo, but over time, you probably do need, even if it's like very fractional, like other people around to help you accelerate the business, the pace things are moving. Um, but I guess stepping back, Venkat, I would think about showing, not telling. So without compromising your IP, can you share like how you are running your business as a solo founder or as a very lean team with tools? So it's not just about demoing your product, but really demoing the platform you're using to run your business. I think we're all seeing these on X, right? The companies that are running their startups autonomously while building their next startup or product or whatever. So um, I'm a believer, and I think more and more VCs will be a believer, but maybe showing will help with that a bit. And I agree with Steve. Steve's point for Venkat, it's not fun going it alone. It is more fun with other people, whether that's on your team or in a community. We're lucky at Hustle Fund. We have over 600 portfolio companies, so they get to share. Sorry, excuse me. We have a founder retreat coming up for that exact reason. And then another question from Salim. How is important where you HQ or live? You've had a lot of requests to move to the Bay Area. So I'm outside of the Bay Area as well. We have two team members in the Bay Area, Elizabeth and Eric, one in Singapore, Sheehan, and I'm just outside of DC. We get this question a lot. We also have the belief that great founders look like anyone and come from anywhere. One of the beauties of the Bay Area is the community, the mindset, right? This like idea of giving first. And I think being at the epicenter of what's happening in AI is really powerful. That's part of why we host our founder retreats in the Bay Area, tell people come in, learn quickly, level up. But we still believe in a remote first world. And I think the benefit of programs like what Serafina's organizing in Bentonville is this opportunity to come together in a very densely and intentionally packed and curated ecosystem to meet with other founders, the best founders and investors and learn together. I think that's what as you know, San Francisco is about. It's a state of mind. So being in places where you can experience that, and part of it's not following the pack, but knowing where are these kind of hot spots where you can plug in, kind of get your charge, and then go off and build, and then keep plugging back in. Great question. And Serafina may have probably much more eloquent things to say around that. So, what do we actually look for? I said a lot of words. I'm going to stop talking in just a couple minutes. At pre-seed, like I said, we don't need to see revenue to invest, but we do want to see a working MVP. Ideally, real customers or a wait list of customers or LOIs with customers, like some sort of proof that you're actively talking to customers and you've validated they want and need this, and there is some sort of willingness to pay. And then lastly, it really comes back to what we stand for at Hustle Fund. So to us, hustle means great execution times velocity. It's taking lots of cycles on whatever the next most important thing is so you figure out and can move on to the next thing. So the teams we back often come with a long list of experiments they want to run to acquire customers, if that's the goal, or to get more specific on the exact problem they're solving or the next product feature or whatever it might be. But it's this experimental mindset that has helped the strongest teams in our portfolio from Webflow to Gamma to Rupa Health just absolutely crush it. I will caveat traction doesn't matter with a note on business model. So I mentioned we're mostly software investors. I do think that aperture is expanding transparently in this moment. I love marketplace businesses. The company I mentioned earlier, Curl Care, is a marketplace business. Marketplaces are, by nature, like much harder to start because you're basically building two businesses at once, and you can get to revenue faster, which like weird paradox, but because of that, we do typically want to see some traction to get comfortable with investing. Consumer is very similar. It's so competitive. Um, like how could you become like the Netflix, Spotify ranked consumer company in terms of retention, revenue, et cetera? You have to show that you can grow in a pretty big way for us to get comfortable, but that's because we don't focus on consumer. And that may be, more of an embedded business model, going business to consumer. And then again, anything that's competitive, we do just expect more. So one example, a company called Rourke in our portfolio, we were lucky to invest after they went viral on Twitter. Elizabeth spotted them and reached out. But they're building in a fairly competitive space, natural language to iOS app generation. And I think we probably would have missed that if it hadn't been for them showing some early traction and a really credible product that worked well even in the edge cases, which is often where AI breaks down. So all of this said around traction not mattering, it all helps accelerate your fundraise. So the question came back to, or the question for the presentation was really around, is your company venture scale? And then attracting funding for that venture scale idea. It could be venture scale. And because you don't have market pull yet, so you're not getting positive input from customers, you don't have that wait list of people banging on the door to use your product. Maybe you don't have investors lined up yet, and or there aren't people around you to help execute on the vision. That can all kind of slow the fundraise down. Whereas the opposite, if you do have one or more of those three things, that can accelerate your fundraise significantly. And you already know this, but I think worth pulling out those three key things. So ready versus not ready, early demand, that 100x growth path. And it might be that, you're building a platform, like someone in the chat asked about earlier. So it's going to look like kind of flat at the beginning because there's a lot to build. You're going to work with a few initial customers, you're going to get it really right, and then it can explode once you get to a place where you become the infrastructure for payments or for all of their workflows or that kind of thing. I see this a lot in vertical SaaS and AI. Um, it's clear how the money that's invested in your company will accelerate your business. So it's not just we're raising $1.5 million to hire people. It's we're raising $1.5 million to achieve a $10 million run rate by the end of 2026 with 100 customers and a clear line of sight to our Series A, for example, right? Like remember that relay race, investors want to see, okay, can we get to that next milestone within 12, 18, 36 months, whatever it might be. And then lastly, this point again won't be easily commoditized. Is this new and super differentiated? And could it still be in 2 years, 5 years? Or could this be a feature of a much bigger product? If you've been asked the question, why won't Google build this? I know it's painful and annoying. And now it's a different company that's, being inserted there probably, but it's a really serious question. And if the answers to most of those questions are no, it probably is not time to raise yet, and or maybe another source of capital is going to be a better fit. So the last thing I'll say, if you do decide to raise venture capital, you're kind of check the box on the momentum and the clear plan for the capital. Um, we see the best fundraises get done very quickly because the founder treats it as a sales process. So without, opening up a spreadsheet and showing you how to list out a bunch of investors and kind of find your warm intro paths, I do recommend spending a lot of time on designing the process before you go out. So you have a great deck, great, like practice giving the pitch, telling that 100x story lots of times, get feedback, and work with friends who are founders, with people like Serafina, with the investors you meet at FX and beyond to generate enough goodwill to be able to run a tight process with a lot of good intros. But don't take an intro here, an intro here. Wait until you're ready to really go out with a bang. I often help founders run processes where we're sending out, 50 plus intros just our fund on their behalf so that they can line up 100 to 200 meetings over a 3 to 4 week period. And that's what you're getting at FX, right? That like really consolidated moment to meet a lot of investors at once, which is really, it's unique. Not, it's like, it's really unique. So, um, if you're doing this solo, just that process is key because without it, you can't build momentum. You can't update everyone else you talk to say, hey, we're on stage 2, 3, 4 of conversations with other VCs to build FOMO and actually get rounds closed. So I shared a ton of information. I'm gonna stop talking, have a sip of water. If you have other questions, I'm happy to hear them. Thank you, Serafina, again.
Oh my God, Haley, thank you. If this were happening in person, you'd be getting roaring applause right now. I was on mute, but the whole time I was going, preach. Yes. Thank you. Thank you, thank you, thank you for
Thank
sharing
you.
your wisdom and your guidance. The world of fundraising, especially for pre-seed founders, can feel so opaque. So these rare moments where we can just ask questions that we otherwise wouldn't have the opportunity to ask, super valuable for our community.
Oh my gosh, of course. Thank you so much. I'm curious to hear more about the selection process because you've had a lot of folks apply. So, what is involved, and what's kind of standing out to you as you're reviewing applications?
Oh boy. So we've had our call for startups live for 6 weeks. Today is the final day. Thank you for putting that up on the screen. We've, some trends are really encouraging. Some trends that we're seeing in the market right now are a little bit discouraging, but I hope that stuff like this is encouraging to pre-seed and founders. One thing that we're seeing is great talent is everywhere. This has been true across every single cycle. We see mostly every state in the country represented in the pipeline, somewhere about around 1,000 companies. Um, in the process of selection, we're really the one and only gate that we're checking on is venture scale. So everything that Haley just went through, that's precisely our lens. And then at that point, those companies are in the hands of investors, and they're the ones that are selecting their top 5 to 10 companies to sit down with at FX. But our goal is to help you, the founders, run a really effective and efficient process. So by the end of that day, you will have gotten many, many reps and many opportunities to share your story, and hopefully you'll walk out with a term sheet. Um, so this whole series is about helping you hopefully show up with a more prepared mind and have an opportunity to to get your burning questions answered. And what Haley just laid out is really about that readiness. It starts long before putting together that deck and the pitch. It's asking yourself a question and answering it honestly. Are you at venture scale? Do you have a 100x opportunity? And that's not to say that you're not a great company and you don't have high potential. This is just one track of many opportunities.
Totally. I know we're at or over time. I think there's one more question I can answer really quickly if that's helpful. From the Q&A, you say a strong deck answers 5 core questions in 10 slides. A lot of founders struggle with length, too much, too little. What is something common founders include they shouldn't? So, yeah, 10 slides is not a lot. And ideally, it's kind of one sentence per slide that read together is your elevator pitch because most VCs are reading slides in, 30 to 60 seconds. So you don't have a ton of time to convince them. Where I think we see a lot of folks stumble is including too much information, especially on product, like going super deep on what the product is without tying it back to the customer, which is why I highlight customer obsession as something really important. So, what is the outcome for the customer in using the product? Features don't mean a lot. It's like really important to map back to that. The other thing is just, I think this is where practicing is helpful. Like as you get questions, you may see, oh, right, okay, a lot of people think this space is competitive. I need to address that like immediately because otherwise you're going to lose people really early in the slides. So I think, keeping it simple, super important. Tying it back to outcome is really important, and making sure you're not missing an obvious point where you're going to lose investor focus. And then, yeah, I think in Dima, your question's great. Why should you go to Bentonville events like Onward FX? I think again, it's not just about meeting a lot of VCs in a very short period of time, which is a very rare opportunity. Truthfully, it is. It's also about exchanging ideas with other founders in a structured way. Those are two like big things. And then, of course, Bentonville is just a magical place. I've been wanting to go back for a while. So, yeah, thank you again, Serafina, for having me.
Yeah, thank you. We look forward to seeing you back in April.
Sounds good. Have a great day, everyone.
Bye, everyone.
Thank you.